Join me as I dive into the world of crypto arbitrage and try to uncover its secrets. Can I find a way to profit from price differences before it's too late? Crypto arbitrage. It's a hot topic in the crypto community right now, and for good reason. The potential for profit is enormous, and many traders are jumping on the bandwagon, hoping to capitalize on those sweet price differences. But is it really as easy as it sounds? Market volatility is a major challenge traders face when it comes to crypto arbitrage. I mean, we've all seen the charts. One minute you're on top of the world, the next you're scrambling to cut your losses. It's like trying to predict a storm. You think you know what's coming, but then suddenly the winds change direction and you're left reeling. And don't even get me started on transaction fees. It's like the crypto equivalent of death by 1,000 paper cuts. Those tiny percentages add up fast, and before you know it, you're eating into your profit margin. Timing is another issue. I mean, let's say you spot a juicy price difference between two exchanges. By the time you execute the trade, the price could have changed, leaving you high and dry. It's like trying to catch a falling knife. You think you've got it, but then it slips through your fingers. And then there's the issue of liquidity. If you're dealing with low-volume exchanges, you can get stuck with a bunch of assets you can't offload. It's like trying to sell a timeshare. Good luck with that. But despite all these challenges, many traders are still making bank with crypto arbitrage. So what's their secret? Well, for starters, they're using the right strategies. Some are employing the classic buy low, sell high approach, while others are getting more sophisticated with triangular arbitrage or statistical arbitrage. And then there are the tools, specialized software that helps traders sniff out those price differences and execute trades at lightning speed. And let's not forget the platforms. Some exchanges are specifically designed with arbitrage in mind, offering low fees and high liquidity. But here's the thing, most traders aren't using just one strategy or tool. They're combining them in creative ways to maximize their profit. For example, they might use a platform like Binance to identify price differences, then use a tool like 3 commas to execute the trade. Or they might employ a statistical arbitrage strategy, but with a twist, using machine learning algorithms to predict price movements. It's like being a master chef. You've got your secret ingredients, your special techniques, and your trusty kitchen tools. One key insight I've discovered is that successful crypto arbitrageurs aren't just looking at price differences. They're also looking at order books. I mean, think about it. An order book is like a window into the soul of the market. It shows you what buyers and sellers are willing to pay, what the supply and demand looks like. And with that information, you can start to predict price movements with a lot more accuracy. It's like having a crystal ball. You're not just reacting to market fluctuations, you're anticipating them. Of course, there are risks involved with crypto arbitrage. I'd be crazy to say there aren't. But with the right strategies, tools, and platforms, the potential rewards are huge. And that's what it's all about, finding that sweet spot where risk and reward align. So